On Wednesday, after the averages fought valiantly to go higher in the immediate aftermath of the Federal Reserve's latest rate hike, they eventually rolled over and plummeted into the close. In part because Treasury Secretary Janet Yellen made some discouraging comments about how she plans to handle the banking crisis. At the same time, let's say that Fed Chief Jay Powell made some encouraging comments about the way he was going to handle the crisis. I mean, come on, guys. Get in the meeting, get it together. As for that Fed meeting, what was so interesting about it was more or less what we saw coming. Powell was actually a bit more hawkish than I expected, given that 3 banks went down right in a row and many others were seeing deposits flying out the door, right? Well, he acknowledged that the banking crisis could deal a true blow to inflation. He also didn't give any indication that he's done tightening. And by the way, the Fed does these dot plots, which show their own interest rate expectations, and they actually showed rates going higher. That said, even though the Fed's projecting a higher terminal interest rate, the federal funds futures are trading like we're going to see rate cuts later this year, perhaps as soon as the summer. Frankly, I just find it's a little confusing. Kind of like that. Either way, we sold off hard Wednesday, and that's what I'm talking about today. Because we had a small comeback yesterday, did pretty good today, but it's pretty schizophrenic because in the morning things were really dragged down by Europe's financial sector. And then after the European markets closed, wow, boom, as I said at the top of the show, things look good. Still, we're starting to see a pattern here. This is what I want to talk about. It's the latest instance where the market's going crazy right after a Fed meeting. But when you look over the data from the past year, there's a real interesting pattern. It relates to whether those initial moves reverse themselves later on or whether they stay the course. Yep, we've been here before, and it all started a little over a year ago when the Fed raised interest rates for the first time in mid-March. We've now had 9 rate hikes in just over a year, which is nuts by historical standards, especially when you consider that there were so many of them that were double or triple rate hikes. So now that we've had a couple of days to take a breath and digest all this week's Fed speak, take a breath, have some tea, you know. I want to take a look back at how the market tends to behave in the aftermath of Fed meetings, at least during this tightening cycle, because that could give us some real insight into where we're headed. And I want you to have the future. I don't care about the past. Remember, it's where prices are going, not where they've been. Now, dating back to March of last year, just before the tightening cycle began, the S&P 500 has seen an average daily move of either no more than 1.15% in either direction. So let's call that the baseline. We've had Fed's decisions 9 times during this period, and on 7 of those occasions, the market had a larger than average move. The only exceptions were in mid-December and early February, during that brief period where we mistakenly thought the Fed finally had a handle on inflation. Now, those first four rate hikes were actually well received, because back then everybody knew inflation was out of control, so higher rates were seen as inevitable. If anything, Wall Street was frustrated with Jay Powell for being too slow to tighten. But as inflation remained stubbornly high while rates went higher and higher, the market's reaction to these Fed meetings got increasingly negative. But you know what? I'm not interested in the market's initial response. Wednesday's already come and gone. I'm interested in what happens next after that initial reaction. And when you look at the market's reaction after that first Wednesday, remember the announcements were always Wednesday, Thursday, and then Friday following the Fed meeting, something very interesting happens. See, after the market's initial move in those first 3 days, we usually go in the opposite direction of the following month. You hear that? The opposite direction. Yep. What I want to say is that the initial move is almost always a head fake. After going over the market's response to the previous 8 rate cycles, we found that 7 out of 8 times the market reversed itself over the following month. The only exception here was the second rate hike in early May, where we sold off hard during the first 3 days, and then we're basically flat over the following month. And when you zoom out 3 months, the initial move reversed itself every time, at least for all of the Fed meetings of this cycle. I want you to digest this while I get my voice back for 2 seconds. You notice? Shameless, huh? Again, it doesn't seem to matter what direction the market initially moved in, positive or negative. It almost always seems to gets repealed. The pattern is just too overwhelming for you to ignore. Last March, starting right up here, the S&P 500 reacted positively to the Fed's initial rate hike, running up nearly 5% over the first 3 days. Then we plunged 18% over the following 3 months. In May, we initially sold off, then rallied slightly over the next 3 months. In June, we had another strong sell-off, followed by a 5% rally over the following 3 months. Yeah, you got to buy these, huh? In July, we got a 5% initial rally, but over the next 3 months, we ended up down 5%. Well, we got to buy them, except for when we have to sell. The September rate hike was brutal, causing a 4% decline in the first 3 days. But the averages bottomed a month later, with the S&P ultimately rallying 4% over the following 3 months. What a buying opportunity that turned out to be. The November Fed meeting resulted in an initial decline of more than 2%. which turned out to be dead wrong. S&P then surged nearly 10% over the 3 months after that. Again, that was a great opportunity there. Similar story in December. We initially got hit, down 4%, but over the following 3 months, the S&P was up 2.8%. While we don't have enough data to run the same analysis in the February rate hike, I can say this market reacted with a 1.5% gain in the initial 3-day reaction period, but since then the S&P is down 4.6%. Once again, the reaction seems like it was dead wrong. We're well on our way to being 8 for 8 of this pattern. So while we sit with this negative initial reaction to the Fed's rate hike on Wednesday, things may feel grim. But there's a clear pattern here. The initial move always seems to reverse itself over the next 1 to 3 months. Of course, now I have to tell you, I have no idea, as I say right here, I have no idea if that trend is going to continue to hold. At a moment where it feels like we've got new emergencies popping up practically every day, especially in the banking sector, it feels dangerous to predict that we're going to rally over the next 3 months just because the market's initial reaction to the Fed meetings seems wrong each tightening cycle. It may happen again, if it may not. I thought this was important, though, because you can see people just were so, I remember these days, like it was yesterday, how upset people were. They were so upset. Here they were so joyous. Here they were so down. This market just, you can't look at it like that. You've got to just deal with the fact that the initial reaction's been wrong. That's the takeaway. Bottom line, I wanted to call this pattern to your attention in order to give you some perspective at the end of a week full of fear. We've definitely been here before. I want you to take a deep breath, drink some tea, and remember that the initial reaction to the Fed's rate hikes has been wrong every time over the past year. Maybe this week's sell-off simply won't be that meaningful, just like the previous reactions. Maybe, as history shows, you should take the other side of the trade. And those who did right now are feeling pretty darn good. Let's go to Carlo in Florida. Carlo.
Hello, Jimbo. How are you? Thank you for taking my call.
I'm coming along. Thank you, Carlo. Thank you very much.
I'm one of the original members for the club, and I was wondering, why don't we include SoFi in the membership, in the group of stocks? You know, they now insure up to $2 million for deposit. You know Anthony Noto. I think you should invite him to the show once again. I think this is a great company to have in our portfolio. What do you think?
Well, Carlo, you know, I am a big buyer of Anthony Noto, Tony. I do feel that the bank did a lot of wise things this week. But I'm looking for companies. I don't really like the financials. As you know, because you're a club member, we've got one straight-up bank, and we've got a bank that's also more fee-based. And they're both doing terribly. And I have to account for myself, and I have to, as you know, because you're a club member, I have to do as best as I can. And right now, one of the better things I've done is to have very few banks. But one of the worst things I've done is to have any banks at all. Let's go to Tyler in California, please. Tyler.
Big booyah from California. How you doing, Jim?
I sense a familial booyah, which has always made me happy, particularly at the end of the week. How can I help you?
Awesome. As a content creator and with the TikTok ban looming, what do you think of Snapchat?
No, we're going to buy Meta. I think, by the way, that the way Congress handles TikTok, I have no doubt right now that unless the Chinese Communist Party throws in the towel, we're not going to be looking at a lot of TikTok. We'll be looking at Reels. Now TikTok, I got to tell you, we switched over at Barcy Miguel to Reels from TikTok. We had a pickup. So what do I know? I'm a sample of one. But I believe that Mark Zuckerberg's spending a lot of time on Reels, and it's only a matter of time before it's better than TikTok anyway. And 150 million people are on TikTok. How many of them vote? Like a million? Because they're like 12. Over the past year, we've had some big reversals in the day. I know, they're much lower. Oh, stop it. We've had some big reversals in the days following the Fed meeting. So stay patient. Don't buy into all the negativity that's out there. I know it's really easy to do it. I don't want you to do it. Much more mad money ahead. Oil's down, so what's up? I'm sitting down with RBN Energy's Rusty Brazil to find out. Then chopping block. A short seller takes aim at a company formerly known as Square, and shares continue to tumble. We'll find out what it means for the stock going forward. You'll want to hear that. And all your calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer.